Everyone wants to know the secret behind the financial success of the world's wealthiest people. Headlines often focus on billionaires buying companies, investing in artificial intelligence, or purchasing luxury properties, making it seem as though the rich play by a completely different set of rules. But when you look beyond the headlines, a different picture emerges. The wealthiest investors rarely rely on luck or constantly chase the latest trends. Instead, they follow disciplined principles that have helped preserve and grow wealth for decades. Their focus isn't simply on making money, it's on making their money work for them. Whether someone has thousands or billions to invest, many of these strategies can be applied on a smaller scale. The difference isn't necessarily the amount of money they start with, but the way they think about investing over the long term. Let's explore 7 investment principles that many of the world's wealthiest individuals use to build and protect their wealth. 1. They buy assets, not liabilities. One of the defining habits of wealthy investors is understanding the difference between an asset and a liability. An asset is something that has the potential to increase in value or generate income. Examples include stocks, businesses, rental properties, index funds, intellectual property. On the other hand, liabilities generally cost money to maintain and often lose value over time. Luxury cars, expensive gadgets, designer items purchased purely for status. The wealthy don't avoid spending money entirely, but they usually prioritize buying assets first. Instead of asking, "What can I afford today?" they ask, "What can generate value tomorrow?" Every asset they acquire has the potential to create additional income, which can then be reinvested into even more assets. This creates a cycle where wealth gradually builds over time. 2. They think long-term. One of the biggest differences between experienced investors and beginners is their time horizon. Many people focus on what will happen next week or next month. Wealthy investors often think in years or decades. They understand that markets naturally rise and fall. Short-term volatility is expected. Rather than reacting emotionally to every headline or market correction, they remain focused on long-term growth. This patient approach reduces unnecessary trading while allowing investments more time to recover from temporary setbacks. Long-term thinking also encourages better decision-making because it shifts attention away from daily market noise and towards fundamental value. Successful investors understand that lasting wealth is rarely built overnight. It grows steadily through patience and consistency. 3. They diversify their investments. One of the biggest misconceptions about wealthy investors is that they place all of their money into one investment. In reality, diversification is one of the most common strategies used by the financially successful. Diversification simply means spreading investments across different asset classes so that poor performance in one area doesn't necessarily damage an entire portfolio. For example, an investor may own shares in different industries, invest in property, hold bonds for stability, and maintain cash reserves for future opportunities. Some also invest in private businesses, infrastructure, commodities, or international markets to further reduce concentration risk. This approach doesn't eliminate risk completely, but it helps manage uncertainty. If one investment performs poorly, others may continue growing. The goal isn't to predict which asset will perform best every year. It's to build a portfolio that can remain resilient under different economic conditions. Wealthy investors understand that protecting wealth is just as important as creating it. 4. They reinvest their profits. One of the most powerful wealth-building habits is reinvesting. Instead of spending every profit they earn, successful investors often use those returns to purchase even more income-producing assets. Imagine receiving dividends from shares, rental income from property, or profits from a business. Rather than immediately upgrading their lifestyle, many wealthy individuals direct that money back into new investments. This creates a compounding effect. Each investment generates additional returns. Those returns purchase more assets. Those assets generate even greater returns. Over many years, this cycle can produce remarkable long-term growth. Albert Einstein is often credited with calling compound interest the eighth wonder of the world. Whether or not he actually said those exact words, the principle remains true. Compounding rewards patience and consistency far more than short-term speculation. Many wealthy investors understand that every pound reinvested today has the potential to become significantly more valuable in the future. 5. Cash flow matters more than status. Many people associate wealth with expensive car, luxury watches, or impressive homes. But financially successful investors often focus on something much more important: cash flow. Cash flow is the money that continues coming in from investments or businesses after expenses have been paid. Rental properties may generate monthly income. Businesses can produce ongoing profits. Dividend-paying shares may provide regular payments. These income streams help finance future investments without relying solely on employment income. The wealthy often ask a different question before making major purchases. Instead of asking, "Can I afford this?" they ask, "Will this purchase improve or reduce my future cash flow?" Assets that consistently generate income strengthen long-term financial security. Items purchased purely for appearance rarely do. This focus on cash flow helps explain why many financially successful people prioritize investments before increasing their lifestyle expenses. 6. They focus on managing risk. One of the biggest misconceptions about the wealthy is that they constantly chase high-risk investments in search of massive returns. In reality, many successful investors spend just as much time thinking about what could go wrong as they do about what could go right. Their first priority isn't making the highest possible return. It's avoiding losses that could seriously damage their wealth. This is why professional investors rarely place all their money into one company, one property, or one business opportunity. They research carefully before investing. They analyze financial statements. They study industry trends. They consider worst-case scenarios. And they always understand how much they could lose before deciding how much they might gain. Risk management also means avoiding emotional decisions. When markets rise rapidly, many inexperienced investors become overconfident and buy assets simply because everyone else is doing the same. During market downturns, fear often causes people to sell quality investments at the worst possible time. Wealthy investors understand that emotions are often the biggest enemy of long-term investing. Instead of reacting to every headline, they stick to carefully planned investment strategies. They know that markets naturally experience periods of growth and decline. Temporary volatility doesn't automatically mean a good investment has become a bad one. Protecting capital allows investors to stay in the market long enough to benefit from future opportunities. For many successful investors, avoiding catastrophic mistakes is more important than chasing spectacular gains. 7. They let compound growth do the heavy lifting. Perhaps the greatest advantage wealthy investors have isn't access to secret investments. It's time. Compound growth occurs when investment returns begin generating returns of their own. At first, the progress appears slow. A portfolio grows gradually. Dividends are reinvested. Investment gains remain invested instead of being spent. Then something remarkable happens. Over many years, growth begins accelerating because each year's returns are calculated on a larger investment base. The longer the money remains invested, the more powerful this effect becomes. This is why many financially successful people begin investing as early as possible. Even relatively modest investments made consistently over decades can potentially outperform much larger investments started much later. Compound growth rewards patience. It rewards consistency, and it rewards investors who resist the temptation to constantly buy and sell. Many wealthy individuals understand that time is one of the most valuable assets an investor can possess. They don't expect dramatic results after a few months. They think in decades. Investing is a long-term journey. Perhaps the most important lesson from the world's most successful investors is that wealth isn't usually created through one extraordinary investment. It's built through thousands of disciplined decisions, repeated over many years. Buying quality assets, remaining patient, diversifying wisely, reinvesting profits, prioritizing cash flow, managing risk, allowing compound growth to work. These habits may not sound exciting, but they have helped countless investors steadily build financial security over decades. The 1% don't necessarily succeed because they always predict the future correctly. They succeed because they develop systems that allow them to benefit from long-term economic growth while limiting unnecessary risks. Ultimately, successful investing isn't about becoming rich overnight or finding a secret formula that nobody else knows. It's about making informed decisions, staying disciplined during both good times and bad, continuing to learn, and allowing time to become your greatest financial advantage. Those principles have remained remarkably consistent for generations, and they continue to shape how many of the world's wealthiest people grow and protect their money today.